Welcome, Nick. Welcome, Lane. How are you both?
Hello.
Good to be here
Good.
with you both.
Lane has traveled a great distance to be here.
Very far.
Where have you come from?
Home. It's not that far, but
I came 15 minutes.
Come on, man. We've come the most. Danny's come from the other side of the
yeah,
whole
I think
planet.
Danny wins
Thank
pretty
you.
much always
Thank you.
in this count. Thank you, Danny.
Thank you for making me your number one most featured guest. Is that it? Is that right?
Yeah, on a Bitcoin show. Well, I mean, how does it work? If you exclude the Lynn, because she's
Lynn, I
like,
was gonna
she
say,
gets a
yeah.
monthly
We
slot.
love Lynn, but she doesn't count because she was like part of the show.
She was a monthly slot, but as somebody who has just invited every time I want to talk to them, yes.
And you still talk to me even though I have been canceled.
So I've got the cancelled Bitcoiner and the cancelled Ethereum guy.
Yeah, this is we realized this recently when we were catching up. It's a nice symmetry.
We're
It's
actually switching sides.
Yeah.
I'll probably get cancelled for making this show. No, of course.
But you know you're doing the right thing when both sides kind of hate you,
Yeah.
right?
If you're not pissing someone off, you're doing something wrong, basically.
We've pissed everyone off.
Yeah.
Well,
Good thing we have each other because
That's all we got left.
well, Nick, you're my friend, so I don't give up. As long as you like haven't done anything super bad, like you would stay my friend. I'm still going to talk to
Thank
you.
you.
You're still one of the smartest people I know. I don't give a fuck what other people think. I'd always talk to you because if we weren't making the show, I'd call you up and say let's get dinner. But when I am here, you've always got so much smart shit to say. I want to talk to you. I don't care what you're doing in ETH. It's a Bitcoin show, and that's what I'm focused on. And even your paper recently showed that you offer so much value. So yeah, I mean, I just don't care. Like you're here for
Thank you, Peter.
multiple reasons. Lane's here for multiple reasons. Also counseled by the ETH community. Also a friend, and also someone I like talking to. I think you can get a lot of value from people who aren't within your. Actually, I think you get sometimes more value from people who aren't within your cohort because you get to challenge things. So yeah, whatever. If we're going to make a show discussing proof of work versus proof of stake, for me, I don't care about the value in proof of stake. I care about the value in proof of work. And if I learn about that by comparing it to Ethereum, that's great. And who better to talk to than one of the best writers on Bitcoin and somebody who like has spent so much time explaining to me everything that's fucked with Ethereum.
And there's more now. So
There's more now.
we're going to have fun with that today.
So yeah.
Yeah, and we're post-merge. I've got a bunch of questions about that first, but let's get into, well, why is it important? You wanted to make this show. You reached out to me and said, look, let's make a show on this. Like,
Did I?
well, one
I
of
think
you
it
did.
might have been my idea.
Yeah, but I mean, for me, always understanding the value of proof of work is useful. We've been hit with a bunch more FUD since Ether's completed the merge from the press, from the World Economic Forum, from mainstream media, from ETH heads, from crypto people who've suddenly used this as an attack vector against Bitcoin, which to me is fucking ridiculous. So sometimes people might be surprised you as an ETH guy, also involved in proof of stake work, wants to talk about this.
Yeah.
They assume because you've done work on other ecosystems, you're not a Bitcoiner, but you are a Bitcoiner.
Yeah. I mean, Bitcoiner first. Actually, fun fact.
Shitcoiner second.
Second and always.
Danny, is this the first time we've had two shitcoiners on the show?
Oh boy,
Yeah,
you are
it's-
really increasing the
Is that
cancellation
what
risk
I
here.
am now?
No, look, the very first project I worked on in the Ethereum ecosystem at the Ethereum Foundation in 2017 was proof of stake, was the merge. And so, I've had a lot of questions about it, both leading up to and now in the wake of the merge itself, people asking what I think and how I thought it would go and how it went. I'm really of two minds about it. On the one hand, I think it's good that it happened. I think it further contrast. It drives home the contrast between Bitcoin and Ethereum. They're even more different now, right? And I think maybe one of the reasons that Nick was excited to talk about this topic is because it gives us even more ground to stand on when we talk about why proof of work matters, why it's important, why Bitcoin is different in that way. So, I mean, you and I spoke about the reasons I have my reservations about proof of stake, like they all still exist. But look, I mean, more information is better. We have, orders of magnitude more information about proof of stake now than we did. We were just speculating when we spoke about it a year or two ago. And now it's like running and blocks are being produced. And like Nick and I were looking at the numbers on the way over here. So we can talk in much more concrete terms, which I think is like a more productive conversation.
Can I tell you something that stood out to me with the merge is that the day after the world hadn't ended,
Right.
Ethereum hadn't blown up, which, not that I wanted it to, but like I expected something super bad or terrible to happen and some kind of collapse. And it was back to normal. DeFi platforms were getting hacked, money was getting stolen.
In retrospect, I think the most remarkable thing about the merge is how unremarkable it was.
Yeah.
Like you said, like I stayed up. It happened like kind of 2 a.m. here on like a Wednesday night or something, the night of September 15th. And like, yeah, it just happened, you know, the rollover happened, the first, you know, block and the first epoch was justified and finalized. And it was like, okay, like get on with our lives. I think no matter what you think about Ethereum, no matter what you think about proof of work, and we'll get into, you know, to that, you have to respect the engineering work that went into this because it was legitimately like a really epic project. And the fact that it happened so seamlessly, I think is remarkable. But after all those years of work.
But isn't it design choices that required such epic engineering?
Yeah, that's fair. I guess that's not required in Bitcoin because it's not changing in the first place.
Yeah.
But you know, look, again, other things being equal, I'm not saying other things are equal. We'll talk about that. But if you imagine other things are equal, the fact that Ethereum is using 99% less energy than it was the day before.
Can I address something though? Justin Drake and Vitalik and many Ethereans claimed that Ethereum's merge reduced global electricity consumption by 20 basis points, 0.2%.
I saw that number.
That is false. That's false.
Why? Because all those ASICs started mining Ethereum Classic.
So partially, that's part of the answer. Another part of the answer is they're relying on figures from Digiconomist for the energy consumption. It was by my count and by the counts of ETH miners that I talked to and other academic researchers, it was more like 8 basis points in the first place. So about a third of the claimed figure. And then also some of those GPUs were not just thrown away. Some of them were thrown away.
Yeah.
But the high-end GPUs, the NVIDIAs, they're now out there churning away running AI models. They're running Stable Diffusion. I can attest to this. I'm actually an investor in a startup that does this. Like they were mining ETH, now they're running Stable Diffusion, right? So the electricity consumption didn't go away. It's just they were repurposed to other tasks. So, you know, at most it's 7 basis points, but most likely it's not all that because a lot of those GPUs are still in action.
I think there's no honest conversation to have about a reduction in energy usage that has any material effect on the world.
I mean, it's a small, whatever it is, it's a small reduction. But I'm telling you, it's not 20 basis points of global energy consumption.
I think the primary conversation with the reduction in energy consumption is how it's been used as an attack vector on Bitcoin and is completely misleading. But I don't see that it's made any material impact on the world. And when you look at the cost trade-off and what it's lost by going to proof of stake.
Can we just dig into this a little bit? It's interesting, right? So there's kind of two ways to look at this. There's the kind of reality, which Nick is speaking to, right? Like what is the actual on the ground like impact on world energy consumption? But I think there's also perception, and perception is important as well. And I think, tell me what you guys think, right? This leaves Bitcoin a little exposed in the sense that our friends, the politicians and the regulators are going to look at it and say, you know, Ethereum did this thing, right, where they sort of, you know, quote unquote, turned off the power. Bitcoin needs to do this as well. Like it's gonna make Bitcoin less favorable in the eyes of people who are environmentally conscious. That's what I'm going to say. I suggest you agree or disagree?
No, completely agree. Yeah, from a PR narrative perspective, it's very strong, and it's very hard to explain to people that Bitcoin can't really marshal that kind of momentum around a massive change, and that it's built into Bitcoin's fabric that it wouldn't make a change
wouldn't
like
want to
this
in the first place, right?
And if they tried, it would be forked, and all the old ASICs would stay mining.
But if you look at it specifically in this way, I just wanted to make this point. It is a masterful PR move
from a positioning perspective. Yes, completely.
And you have projects
it's not just PR; it's like actual governments are responding to this. Like, look at the EU. They're actively trying to ban proof of work. They weren't successful, but they're trying.
This is one of the main reasons the world hates crypto so much. There were projects, pretty big projects like Celo comes to mind, that launched, an entire chain, a whole ecosystem, raised hundreds of millions of dollars specifically around being carbon neutral. So I think Ethereum's move has kind of stolen their thunder.
Well, again, I think it's misleading, but I understand like the PR side of things because I've seen it. I've seen the articles that came out the day after.
There are two front page articles in the New York Times, in the day following the merge. So if you think about it it's a PR,
it's a big win from a
and those articles weren't terribly great, and they got facts wrong as they always do. But
this is why we need to ensure we continue to fund people like the Bitcoin Policy Institute to start writing the articles to try and educate these people and at least offer them some like real fact-based information.
But the upside, as Lane says, is now we have real data coming out of Ethereum proof of stake. I mean, obviously there were other proof of stake protocols, but like Ethereum proof of stake is a big one where now we can actually clearly delineate the influence of either consensus protocol.
It's the biggest by far, but it's also, we have to, when we compare proof of stake, like Ethereum flavor proof of stake to the others, we have to emphasize that it's really different because it's not delegated proof of stake, right? This is, I think, the first chain that is really doing it at this large decentralized scale with hundreds of thousands of validators. That hasn't been done before.
Yeah. Other chains that are like proof of stake are basically like consortia of like a handful of known named validators.
Although you could make the case that Ethereum is too, given the reality.
Well, we'll get into it.
But like, look at compared to Binance Smart Chain, just like Binance hits the brakes because something goes wrong.
Yeah.
That's not really like a open consensus system.
So and Solana.
I started calling it Solana because of you.
I've forgotten which one it is now because I keep getting it wrong.
We were not telling
Roberto Solano, isn't it? The old footballer who played for, was it Villa?
Is it up today?
I fuck knows.
We need is Solana.
Yeah, but they have the
up.com.
highest Nakamoto coefficient. Have you seen this?
Don't they just turn it on when they need it?
They're saving energy.
Yeah.
These other ones, these non-Ethereum proof of stake chains are more brittle, and they're definitely just rely on a smaller consortium of larger validators.
To be fair, we don't have enough data on Ethereum yet. I mean, this merge just happened less than a month ago. Solana's been running for a couple of years, so like, let's see how stable it is. I mean, the Beacon chain has been running, so proof of stake has been running since December 2019, so almost 2 years, 3 years, 2 years.
Beacon chain.
The Beacon chain, sorry, December 2020. Yeah, so that's. By the way, if you want to do background story, I mean, it's always helpful to catch people up. Like, what is proof of stake? How did this all happen? Right? We could go over that. But
just
we just don't have much data on how stable it's going to be. So we'll see.
But one quick question that might not have a quick answer is: now the merge is done, is the transition done, or are there still things have to be done? Or it's like ETH2 just live now and all the old stuff's dead?
Yeah, this is complicated. I'll try to give you a really brief answer. So the merge itself is done.
Yes.
There's nothing else to do on the merge. The Ethereum roadmap has evolved quite a bit. The running joke in my days when I was doing Ethereum stuff is that every time Vitalik had a shower, the roadmap would change. It's not quite that volatile anymore. There's like a pretty agreed upon roadmap forward with 5 steps, the first of which was the merge. So there's kind of like 4 more big steps to come.
But what did the merge do? What was that?
The merge was the transition to proof of stake. So
Okay.
it was hot swapping out the consensus mechanism from proof of work to proof of stake. That's all it did, nothing else.
And that took 3 years?
7 or 8 years of research and 4 years of development.
Wow.
Yeah.
You're gonna love the rest of the roadmap because it rhymes.
Yes. I can't even get them all right, but merge, verge, surge, purge, and I'm forgetting
Splurge.
one. Splurge. Right. Of course, the splurge comes last.
So it's like
Everything in Ethereum is rainbows and unicorns and
I was
rhymes.
going to say, is there a song?
Don't you love it?
And
I'm sure there's a unicorn dance song.
There's a unicorn dance song that they're going to do at the next Dressed as Fluffy.
I'm telling you, the more
They all
I realize
mean
this,
things,
the more I
though.
realize like Ethereum has got its marketing game on lockdown.
I
like
mean,
all this
a
stuff.
rhyming roadmap. It's incredible.
And
Well,
rainbows
it's,
and unicorns.
And the words mean stuff. Like there's actually like
Right, there's substance behind it.
there's
There really is.
substance,
Yeah. Yeah.
What's that book? Something Huxley wrote.
Aldous Huxley.
Yeah, what's the book he wrote?
Brave New
Brave
World.
New World.
Yeah, so that's Brave New World. Ethereum's Brave New World, and Bitcoin is 1984.
This is the utopian and dystopian views of the future.
Yeah, I mean, look, and as I said to you before, like Ethereum, sometimes it feels like it's defined by unity. There's a lot of unity around things, whereas Bitcoin is defined by like the lack of unity, the fight.
We say Ethereum is a big tent and Bitcoin is money for enemies. So I think that's accurate. I agree with that.
I think groups look homogenous from the outside, and from the inside they look heterogeneous. So they probably say the same about Bitcoiners. Yeah, that's just like a common sort of like phenomenon.
I think the thing about Ethereum as a community, to the extent that such a thing exists, is it is complicated and it does feel diverse on the inside because there's all these projects that are Ethereum adjacent. So like is Polygon part of the Ethereum community? Is Near or Polkadot? Some of these projects kind of move in and out of Ethereum's orbit. It's messy. Whereas Bitcoin is Bitcoin, basically.
Okay, so we've done the merge. What's next?
I don't even know what the next one is.
I don't either. I'm trying to remember. I think dank sharding is kind of the next thing. Oh, no, sorry. The first thing is withdrawals. So
Yeah.
So 30-second recap, right? So the Beacon chain launched in December 2020. All that did was proof of stake, but so validators could deposit ETH on the main net, the existing running Ethereum network, and then people who wanted to run validators, and then that would give them a validator kind of slot on the Beacon chain. So for whatever number of months that is, 19, 20 months or something, that did its thing, but it's not coming to consensus over anything meaningful. They're just running, and it's just literally testing the consensus mechanism. Then the merge happened. So now the security of the running Ethereum network has been transferred. As I said, all the proof of work miners have been shut down. That's been transferred to proof of stake. So now the consensus is still running on the Beacon chain, but it's now securing something. The next step is enabling withdrawals.
Well, so you have to stake to be a validator?
Yes,
and
exactly.
32 ETH.
Correct, yeah. So that's one validator slot. It's a fixed amount. But yeah, so the next thing is enabling withdrawals, which is supposed to come in something like 6 to 8 months. So basically, once you deposit now, right, you cannot withdraw those funds. So they're locked on the Beacon chain, right? What you can do, and this is actually, it's interesting, this interesting nuance here, you can exit your validator, right? So what that means is that you, like, let's say that you are, we won't name names, but you're a regulated sort of entity or company who, for whatever reason, like doesn't want to censor, doesn't want to produce like censored blocks. We'll talk about the censorship thing, I think. Your only other option would be to exit your validators and stop validating, but you can't actually withdraw the coins.
So even if you exit, you can't withdraw?
Correct, not yet. But that will be enabled in some number of months from now.
And the useful thing would be what people don't want to withdraw all the coins, but they want to withdraw the
rewards,
the yield that they've generated.
Yeah, so this is also complicated. So there's two components to the yield you get when you're a validator. So one is the block rewards or the block subsidy, and the other is the fees, obviously. The fees can be withdrawn because they just land in your regular Ethereum account.
Right.
But the block subsidy cannot yet.
Okay. So what's the complexity around withdrawals?
That the funds live on the Beacon chain, not on sort of the running Ethereum chain, I guess. So there needs to be some mechanism.
So is that so will both chains continue, or will the Beacon chain merge into the main chain?
So both chains, so there are now two chains, basically. And you, as a validator, you actually need to run two pieces of infrastructure. So the terms we use are EL and CL. EL is execution layer, CL is consensus layer.
I'm glad you're here because I didn't know any of this shit.
I wasn't following this all super closely for the past couple of years. As you guys know, I have a day job that's not strictly Ethereum related, but I've been catching up on it lately, partly because of the merge, partly because of the show, partly because DevCon is coming up. I don't want to sound like an idiot.
When's DevCon?
Next week, so I'm actually on my way to
Bogota.
Yeah, that's going to be
nice.
It's going to be interesting.
The cartels are warming up.
Have you got your unicorn outfit?
I mentioned I was packing for Bogota, and it was really hard because I was trying not to bring any crypto swag or ETH swag, and most of my clothes.
You're going to want to have good OBSEC when you're down there.
Yeah, I mean, of all the places to choose to put a bunch of rich crypto people, let's go to Bogota.
Doesn't seem wise.
A bunch of teenagers who are newly crypto wealthy, who've never traveled in Latin America before.
Yeah. Okay. So after withdrawals, what's coming after that?
I think the next thing after that is sharding, and this now is getting a little bit beyond my expertise.
Did you say dank sharding?
Yeah, they rebranded it. I think it's because the name of the academic.
Conrad, I think.
Yeah. So it's not dank as in cool. It's because it's actually this guy's name. But it's also, I guess,
but that's a cool name.
It's a pun, I guess. That's with everything.
Okay, and sharding does what?
So the idea of sharding is that rather than having a single chain where each validator has to validate every transaction on that chain, there are now multiple chains and a subset of the validators. So the chains get broken up into sort of subnets. And so you only need to validate a subset of the overall transactions flowing through the networks. By the way, sharding is a really old idea. It comes from databases. It's been around for decades. You have some method by which you split up your transactions and your accounts across different chains.
Because to reduce bloat, to make it
reduce
faster?
The load on the validators, because you want it to be easy to run a validator, basically.
So it sounds like that's probably quite a complicated thing.
That's very complicated. So the plan was originally that would be included in like an earlier phase in what used to be called the Ethereum 2 roadmap.
Okay.
And I think dank sharding is like, again, this is getting a bit beyond my expertise, but the original plan was to have something like 1,024 shards or something, and they'd all look and feel like Ethereum, and the scope of this has been reduced considerably.
Okay, and there are any risks to sharding in that, like, parts of the network go offline? Is it a new attack vector?
The biggest issue of sharding is that it breaks composability.
Yeah.
You want to explain composability?
Well, it's just that now
For the
you're
audience,
creating,
obviously know what it is.
you're literally, splitting the ledger up
Yeah.
from a canonical ledger of record to many different ledgers that need to be reconciled with each other. And now the challenge is, how does a transaction happening on this piece of the ledger talk to, a contract on that piece of the ledger? And composability is like the nice thing about blockchains. That's what makes DeFi work. That gives you the strong, having those settlement assurances means that these contracts are going to work together.
Right. So I agree. I think Ethereum's killer feature is composability, right? So this means that literally in a single transaction, in a single block, you can touch 3 or 4 or 6 or 8 different applications, right? And compose, both in the sense of building blocks of code and things like this, but also in the sense of assets, right? You can kind of do these wicked arcane kind of transactions that, take a flash loan here and do something over there and then like return the flash loan at the end. That is the thing that was never possible before Ethereum and is only possible on Ethereum or a system like it, right? Where you don't have shards today. And I'm specifically referring to how things work in the Web 2 world, where you have APIs and asynchronous calls, and like you have this thing called the train and hotel problem, which is like I want to book, a train ticket and a hotel, but if for whatever reason I can't, the train reservation doesn't get made, I don't want the hotel, and if the hotel reservation doesn't get made, I don't want the train. So we want these things to be bundled as a single kind of atomic operation. So it's all or nothing. This is called atomicity in computer science. And the moment you move to a sharded model, as Nic was mentioning, you have these multiple domains. And now you have these very, very, very complex asynchronous tools as a software developer that you need, where you have to fire off a thing and sit around and wait for it to come back, and maybe it'll fail, and then you have to revert the first thing. So it just makes writing applications and using them much harder.
Hold on. So so this needs to be solved by the coders building the application.
This can't be solved. This
can't
is a
solve
fundamental
it.
trade.
Yeah,
It can't be solved.
it's the problem with legacy payments is they
Exactly.
aren't composable.
So what
This, by the way, this is why you have things like a 2 or 3 day settlement period, right?
Yeah,
Because this is exactly
it's
why.
why interchange exists with credit cards.
Right.
It's why fraud risks exist. It's because legacy payments aren't composable.
Okay, so what's it going to break on Ethereum? It's going to break something.
The whole premise, in my
DeFi,
opinion. Yeah,
in a nutshell.
DeFi.
Yeah.
Okay, so why? Does that mean it's not going to happen, or is this a big debate?
I think it'll come down to it, and they'll walk back from the brink and not go the sharding
Would you say
model.
Ethereum is on the brink?
I mean, other smart contract chains are selling against this, right? So
Exactly.
like Solana's whole thing is they're going for composability. They're
Right.
not going for the sharding model.
And then you have chains like Near that have already deployed the sharding, and I don't think it's super popular. I don't think there's been a ton of uptake. I want to make one other point, which
But
is
hold on, if it breaks smart contracts,
composability.
sorry, why would it even be considered if this is ETH?
Right. So the answer is scalability, right? So there is a limit to how many transactions you can put through a single chain. So just one really important point. This problem already exists, right?
Yeah.
Why? Because we have multiple chains and because we have rollups and layer 2 stuff now. It's precisely the same problem, right? You now have these towers or these islands, these silos, I guess would be the word
it
for it, right?
predates blockchains,
Yes,
right?
exactly.
This is like a problem with payments.
Yeah.
Is if you want efficiency, you need deferred settlement. That's the fundamental payments
Yeah,
trade-off.
there's no squaring the circle.
So
This is a fundamental
we
trade-off.
like sort of rediscovered this in the blockchain.
We're rediscovering a lot of things in blockchain.
But if it breaks one of the USPs of Ethereum,
The killer feature.
the killer feature, then it changes Ethereum. Then what does Ethereum become with it? Is it just a more complicated Bitcoin?
This is the whole journey of crypto.
Oh, God.
Is
I have
we're
to-
rediscovering.
Hold on, I have to emphasize the point there because somebody listening will be like, it's not Bitcoin. Like I know that, but does it just become money and not smart contracts?
I think that the whole journey here is, someone summarized this by saying that like crypto bros are learning the lessons of that finance learned over decades, right? In fast forward, like that's kind of what's happening.
Right.
So
Okay.
the short answer is it becomes more like, to Nick's point, the kind of existing financial system.
So if they do get through sharding, what's after that?
So statelessness is a big thing on the roadmap, right? This is the purge, I think, right? So the idea is that running a node now takes hundreds of gigabytes of data, a lot of cruft from years ago, spam attacks and things in the past, and there's no reason for nodes to need to store all this data. So there are pretty advanced techniques involving things called Verkle trees and that's another fun branding thing, that basically just advanced cryptography that means that you don't need to store all of the legacy data to run a validator. So again, this is in the interest of kind of making it as easy as possible to run a node or run a validator. And then later phases like the splurge thing, like once we've done this and we've cleaned things up and we've streamlined things, then you can add more fun stuff in the future.
It sounds like a project that's going to take decades.
Yeah. It's been almost a decade.
Yeah.
Well, it's like the revolution never ends. What would they have to live for if they weren't continually?
I never thought about it in those terms, but wow, that's a powerful idea.
I mean, you've just described the opposite of every reason I like Bitcoin. Like
I was
it's just
thinking,
the simplicity.
That's the beauty of it is now we can really compare the two.
I was thinking on the way over here that I think you guys would probably agree if I said Ethereum is on the order of like 10 times more complicated than Bitcoin, right? If you figure smart contracts and EVM, right? So that's
way more.
So wait for it. So this is old Ethereum, right?
Okay.
So now we have two Ethereums, right? So we have the execution layer and the consensus layer. So that's doubled again. So now we're at 20x or 30x, right? And then on top of that, you now get to add MEV, which we haven't even gotten into. And I think MEV is like another order of magnitude of complexity here.
Yeah, I've seen some conversations about that it can be gamed and it means you can front run things. And
so we're getting into like keeping up with Ethereum today now feels like being a doctor, right? You know how you can't be an expert in medicine, right? You can be an expert cardiologist. You have to have a narrow specialty because the field of medicine advances too quickly. And even within a field like cardiology, I think you probably have to be a specific type of cardiologist today if you want to keep up with the science as it advances. So this is kind of the level. I'm just trying to lay the foundation here. This is the degree to which Ethereum has become complicated. And guess what? That also makes it feel more like legacy stuff.
Yeah.
Whereas Bitcoin is still Bitcoin. It's still simple. You can explain Bitcoin to someone like thoroughly in an hour.
Yeah, and it works. And it doesn't seem to have a lot of the issues that, say, Ethereum has with, things. Well, let's be fair to it. It doesn't seem to have as large an attack vector.
For sure.
Attack surface, sorry. And I mean, like, I'm not far from a technical person, but I feel comfortable where I am with Bitcoin. I've never felt comfortable with Ethereum, and I feel even less comfortable.
You should
with
feel
it
less
now.
comfortable today. That's my point.
I can't see it. It feels like about safe as keeping my money in pound coins. Okay, right. So, why did they do this?
Who is they, and what's the this?
People, Vitalik and his mates. Why did they do this? What was the reason to do this?
For the proof of stake,
the whole thing, or this entire roadmap? Is it because Ethereum 1 just could not scale?
I think the sort of one sentence answer to your question is it's a better Bitcoin. That's always been kind of Vitalik's vision since the beginning, and I think it's important to note that proof of stake, like the fundamental outlines of this roadmap have not changed since 2013, 2014. It hasn't changed. The details have changed, but the fundamental
white paper.
It was even before the white paper.
It's forecasted. Vitalik's view is that proof of stake gives you more configurability, a greater design space.
Cheaper security, more security.
Yeah, they think it's cheaper. I certainly would dispute that, but
Do you think he believes it's better than a better Bitcoin or a different cryptocurrency?
The way I've heard Vitalik describe Ethereum is that versus Bitcoin and other kind of single purpose chains is that Ethereum is the general purpose platform. It's like the smartphone to Bitcoin's Swiss Army knife or to this, each individual chain, that arose, like the colored coins and then the name coin and all this kind of stuff. Like they were each like adding a feature to the Swiss Army knife, whereas Ethereum is just kind of this general purpose thing that can do everything. So it is in at least in one specific computer science sense, which is the fact that it's a Turing complete virtual machine, which you can run anything on. At least in that respect, it is strictly better than Bitcoin. Again, I'm talking about this one dimension. Of course, there's a cost here in terms of complexity and security and things.
Have all Ethereans been brought along with this and been supportive, or have people been lost along the way?
The vast majority. I mean, I was lost along the way,
but you're one of the very few.
Yeah, I'm one of the very few conscientious dissenters who like really isn't a huge fan of proof of stake.
But yeah, not many. I mean, the miners I know didn't like it, obviously.
Yeah, but no one cares about the miners.
Yeah, they were hated. I mean, for most Ethereans, it makes sense to go along with the roadmap. Like, why not?
Well, I mean, I think by being an Etherean in the first place, like you are almost implicitly subscribing to the roadmap. You're drinking the Kool-Aid.
Yeah, so you believe in it.
So you said you specifically don't like proof of stake.
We did a whole episode on that,
I
didn't
know.
we?
Not everyone will have listened to that one. So let's get back into it. Why is it you don't like proof of stake? Whatever its flaws, comparing it to Bitcoin.
Yeah, so I definitely suggest people check that out for a much more in-depth analysis than we can do here. But I will give you certainly the one-sentence version. Actually, someone phrased this way recently, and I really agree with it. You could describe proof of stake in 2 words: shareholders vote. And guess what? That is how the world works already. And for my part, the whole reason I got into this space 5 years ago or whatever it was to do something different. Like I want to build a system that at least has the potential to be democratizing and move towards decentralization, censorship resistance, these properties that we care so much about. And I think proof of stake is a huge step in the wrong direction. So that's the really short version.
So what do they get to vote on, and how do they vote?
They vote. So here's the crazy thing: they vote. They being again the validators, the stakeholders, and they're the same. They're one and the same group in proof of stake, which they're not in proof of work. This is something else Nic and I talked about, and we should zoom in on this because it's a really important point. There's kind of 2 separate classes of actors in proof of work, whereas in proof of stake, they really are one and the same. They vote not only on which transactions to admit in the order, right? So that's just the block construction piece. But here's the key thing: they also vote on the next set of validators. So there's this kind of circularity to it.
Okay, so they vote what's in the block and the order. How can that be corrupted? How many validators are there? Does it come through collusion?
Okay, so I mean,
like, what is the risk here? What is the risk here? We know with Bitcoin that the miners are essentially financially driven. They will just pick up the best transactions and build the blocks and move on. And yes, there are sometimes requirements. We have seen that with OFAC.
Well, yeah, it's more complicated than Bitcoin. You have to address pools. Yeah. You have to address these nexuses of centralization. There's layers on both stacks, the proof of work stack and the proof of stake stack. So we can't be fully utopian about Bitcoin either.
No. But let's talk about them both. So let's talk about how Bitcoin does it first. Then
I think that's a good idea because it's simpler.
Yeah. How does Bitcoin do it?
Well, in my view, you have different layers. So one layer is the literal physical infrastructure, and that's physical ASICs, and then energy, and then other ancillary infrastructure, and those are organized within corporations. And many of them are publicly traded. So like there's, definitely points of leverage and centralization there. They then submit those transactions to pools, which do the block templating and the block construction. And so if you were looking for, points of centralization or government influence, it could be at either one of those layers, right? And so I would say those are really the 2 key layers. I don't know if you would identify.
Yeah, and I think to be fair, especially with respect to the first layer, Ethereum has had a leg up here, right? Which is because of the fact that ASIC manufacturing is much more centralized than GPUs. And now, to run an Ethereum validator, you don't need any specialized hardware at all. And also with respect to energy consumption, right? So this is actually one of the very few arguments in favor of proof of stake that I do agree with, right? Bitcoin miners, proof of work miners have a very large energy footprint, whereas proof of stake, validators, you could spin these things up as VMs anywhere, you could move them across the world, but there's no energy signature. So that is one benefit to proof of stake.
So they're more identifiable and they're less mobile.
Well, but what is the benefit to proof of stake? Because if you haven't got the energy cost, you haven't got the input cost to create the money. We haven't got them. Well, as Nic Carter says, everyone knows unforgeable costliness. You don't have that.
I totally disagree with that, actually.
Yeah.
So you disagree with that?
Yeah. So I think proof of stake is costly. I think capital is a cost. Yeah. You can use
it's
that
opportunity cost of the capital that's locked.
Yeah, and so basically. Money has a cost. It's called interest, right? So there is a real cost to locking up, let's say, $20 billion on Ethereum. That could have been deployed to anything else, and I would compare it to government debt, basically. So think of Ethereum staking as like the blockchain equivalent of like T-bills. In the real world, when interest rates get really high, the sovereign interest rates get high, it crowds out private sector spending, right? This is a very well-documented thing.
It's kind of what's happening now. We're starting to, right?
This is precisely what's happening now. It means there's less activity in the real economy because everybody's just parking their money with the government and getting paid for that. Same thing in Ethereum. Ethereum, the protocol, pays you to park money with them. That means that money could have been doing something else, anything productive, whether it's in the blockchain context or in the real world. So you have to understand that that's basically a cost because it's an opportunity cost. The capital could have been deployed to build nuclear power plants or windmills or something. So as a capital allocator, I assure you, capital has a cost. It's a real resource, and there's a finite amount of it. It's not as obviously evident as electricity or silicon, but it's still a costly good.
There is still so I agree with that very strongly. So thank you for making that point. I do think there's still a difference to highlight. I think I'm going to keep quoting people who are smarter than me and more eloquent than me today because it's helpful. So like Lop said this recently on Twitter. He said, proof of stake is rent seeking. Proof of work is meritocracy, right? And there's some nuance there, and we could pick that apart. But I think the basic idea, and I say this as someone who has been doing this and has done both forms of mining, proof of stake is kind of set it and forget it. You kind of spin up these validators. There's some very minor degree of maintenance required. You have to install patches and make sure your keys are secure and things like this. But relative to the cost of proof of work, the kind of ongoing maintenance cost, it's low, right? Whereas with proof of work, as you guys know, the miner hardware, the ASICs depreciate very quickly. They have, I don't know what the full lifespan is, but it's
today it'd be like 5-ish years, you would say.
Yeah, and better hardware comes along, and you have to constantly chase the cheaper source of power. I guess that's probably the larger cost. So,
well, there's a point in that as well. There's the competitive nature of Bitcoin mining. What does that give you that proof of stake doesn't? What's the benefit of the competition within the mining?
Well, it's a very powerful benefit because it means first of all, it's a very free market, open, competitive space. There's no way to get a strong, enduring advantage.
Someone could come in tomorrow, and this has happened historically, and just build a better ASIC that's 10x better or something, capture the market as they deserve to. That is not possible in proof of stake.
Well, but it's not even about the ASICs. The ASICs are pretty commoditized. There's actually a bunch of suppliers now. I'm not as worried about that. I mean, I would just say historically, there's been no miner that has super dominated.
Right.
There's no one that's that dominant. In fact, there's a ton of churn. So I would put that a point in favor of proof of work.
We did have one, didn't we? Like 8-9 years ago, someone was like approaching 51%, and they walked.
I remember that. They walked it back, didn't they?
That was Ghash. That was a pool.
Ghash. They walked it back, didn't they?
Difference between the miner and the pool, but yeah. I mean, the pools is something people have historically pointed to in terms of like these nexuses of centralization. But on the miner level themselves, the biggest miner in the world is probably GDA. They don't have that much hash rate. The biggest miner publicly traded in the US is probably Core Scientific. Again, if you look at their share of all the exahashes, it's not that much.
And is it getting lower? Is it getting more decentralized?
I think it will get more distributed over time. It will be concentrating now for a little bit because there's consolidation. Mine is going bust. There'll be some M&A activity. But over time, there's no there's very significant diseconomies of scale once you get to a certain size because there's political constraints to how big you can grow. There's just not that many huge energy resources that are freely available. Like energy is a very globally distributed thing in terms of cheap energy. So it's just very hard to become enormously large.
I think this is a key point that people totally misunderstand about proof of work versus proof of stake. So I'm really happy you brought this up, and specifically that you mentioned the diseconomies of scale, because one of the arguments I hear above almost everything else on the Ethereum side in favor of proof of stake is the mistaken belief that there's a large economy of scale in proof of work mining and that this is not the case in proof of stake mining. I actually think the opposite is true.
It's a discontinuous, whatever.
That's fair.
It's a non-monotonous relationship, right? Because yes, as you're getting to a certain scale, you probably have economies of scale in terms of like a literal, amortizing the cost of the data center. But as you get super big, now you run into political constraints. You start getting banned in certain countries. You run out of like cheap electricity. There's a finite amount of that available, a very finite amount. On the proof of stake side, I would say there are definitely economies of scale at an arbitrary size.
It's blazingly obvious to me. And I don't understand. This feels like very disingenuous on the part of Ethereum folks who have been arguing the opposite point. And again, I can tell you as someone who runs this infrastructure, I'll just make one very simple point. In order to run a validator in Ethereum, you need, as I said, kind of two pieces of infrastructure. You need this kind of like EL and CL thing, execution layer and consensus layer. The execution layer thing is very heavy. Okay, this is validating the entire Ethereum blockchain that has been running since Genesis, and it there's hundreds of gigabytes, and you need a fairly powerful system and high bandwidth, et cetera, et cetera. However, here's the key thing: the consensus side is very lightweight. Okay, and you can run an arbitrary number of validators, as many as you want, hooked up to a single piece of infrastructure that does like the execution layer side. And so you're amortizing, and this is just economics 101. You're amortizing the cost of that execution layer client over potentially dozens or even hundreds of validators. That is the definition of economy of scale.
I mean, the other more abstract version...
Why would they want to deny that there's an economy of scale?
They will say that the rewards you earn are directly proportional to the number of validators you're running, which is to say to your stake, right? So if you double your stake, you earn double the rewards.
Okay.
And that is technically true, but it's only looking at the capital cost piece that Nic spoke about. It's not looking at the operational cost.
But why is an economy of scale, why is that a negative?
It's bad because
it leads to centralization.
Over time, you'd have a few large entities doing all the validation.
Economy of scale, by the way, is just the rich get richer. It's
yeah. No. But so what you're saying is they will push out other validators.
Yeah. So obviously, it's bad if there's like a tiny handful of validators, whether it's proof of work or proof of stake. Empirically, we know proof of work has not concentrated with a small handful of validators. There's a large number of validators, public, private, globally distributed, all over the place. Miners. Yeah. In proof of stake, in long term at equilibrium, and we'll see what happens here. If you look at the coins on exchanges, it only ever really grows as a share of the network. These blockchains, the assets get more custodial over time. And who really wields the most power when it comes to staking is the asset managers, the banks.
I think we should talk about this because this is a key thing.
So we never finished though. What are the risks here with the validators building blocks? Arranging the order of blocks, like arranging the transactions. What can they actually do? Because, like I say, an individual miner or a pool who closes a block. Actually, you have to correct me. I don't know if a pool does the pool create the block or the ASIC that would.
This is an interesting point. We're talking about this too.
We've struck on the key point here, and we should talk about this in both proof of work
the
and
ASIC
stake.
builds it.
No, it's really the pools that construct the block.
The ASIC is just searching for the nonce. It's not
right. Okay, so the ASIC builds the block. Okay.
Sorry. The ASIC they literally just grind away looking for the nonce.
It does, and then the pool builds the block.
It's currently happening at the pool level,
of course, because then the pool gets the Coinbase and distributes it.
But this is a problem, right? Because now it does mean that the pools have a degree of influence, right?
Yes.
And the pools could, in theory, comply with OFAC or something like that.
Okay, well, we will come back to that. But how does I don't know, how does the centralization within Ethereum with the validators there, what can they do? What is the kind of shitty things they can do?
So I think this is multifaceted, and I think that there is kind of a political economic component to this, which again, you and I spoke about last time. We talked about the Cantillon effect and stuff, which we could talk about more today if it's interesting. It is interesting. But I do think the most salient example really is the censorship question. So I think I would say the shortest answer to your question is what they can do is they can censor transactions, and they could halt the chain, theoretically. There are a few more pernicious things they could do, such as a long-range attack, right? So these are things that are only possible in proof of stake, not in proof of work, or a simulation attack, where, for example, a validator who is no longer a validator, we talked earlier about like exiting, right? So they can kind of say, mic drop, I'm done, I don't want to validate. They have to get into this exit queue. It takes some number of days or weeks or something to exit, and that's so that they can still be penalized for some period of time for bad behavior. But once they're done and they're gone...
is bad behavior?
No, I'm saying if they were to commit bad behavior kind of before exiting, you still need a window during which you can punish them, right? Okay. But that window has to end. Eventually, they have to be able to withdraw their funds and walk away. Once they've done that, they could then still do bad things like sell those keys, like sell their keys to bad actors. And if a bunch of validators do this, then you could have bad actors who kind of buy up these keys from exited validators who can no longer be punished because they exited. And that can be used to carry out some pretty severe attacks, like these long-range attacks. That's not possible in proof of work.
That's all fairly hypothetical, I would say.
But what are these attacks?
I mean, it literally would be like... So the thing to understand is that in proof of work, every block you add to the chain, there's a provable cost to doing that, right? A thermodynamic cost associated with the proof of work. And so if you wanted to, add 100 or 1,000 or 10,000 blocks to the Bitcoin blockchain, right? You can't simulate that without actually doing the proof of work. It cannot be forged. That's the key fact, okay? In proof of stake, simulation is costless. There's no proof of work. So you can, assuming you have the keys that I spoke about a moment ago, you could build a chain of arbitrary length instantly, just like that.
Right.
And then
empty blocks.
Because the way it's called the fork choice rule, right? So if a node that was offline, right, that hasn't been following the chain, if it's presented with these two chains, there's no way for it to differentiate. It can't tell inherently which of them is the longest chain. Again, unlike in proof of work, whereas in proof of work, they can immediately tell which one has the most accumulated proof of work. So these are key challenges that have had to be considered in design of proof of stake. But as Nic said, and I agree with this, they're very hypothetical attacks. I'm not aware of this ever having been done in practice. But I will say, if the stakes get high enough...
Yeah, I mean, it's something to be mindful of. But the real sort of like bad stuff the validators can do is censoring, which is happening today. and MEV, which is just an inherent feature of the blockchain.
Actually, let's do MEV first.
These are the two big.
Yeah,
big
let's do
items.
MEV, then
Big
we'll come back to
baddies.
censorship, because there's a lot more to that I want to get into, because there are risks with censorship within Bitcoin. Because who was it? Who was it? Marathon who signaled that they were OFAC compliant at
They
one point.
tried to create an OFAC compliant pool. But
Yeah.
I will say, if Bitcoiners are hanging their hat on the non-existence of OFAC pools, they're going to be disappointed, because there will be
Okay,
OFAC compliant
we'll
pools
come to
in
that.
the
I think I
they're
reluctantly
under
agree with you.
development.
Yeah, no. I mean, I just reluctantly agree it's going to happen.
I don't think it's a deal breaker, but it will exist.
Yeah.
For sure.
Okay, so let's talk about MEV. Explain what it is.
All right, let's do this. I'll go first and
I'll give Lane-
fill in
I'll give
things
Lane the
I
floor
missed here.
here.
So this is a complicated topic. I've been following it loosely for it's only been a thing for 2 or 3 years, and I finally had the chance to kind of begin deep diving on it recently, and so I'm really excited to talk about it because it's so interesting. So I think if I had to boil it down to the most fundamental form, we were chatting about this earlier as well, it really is an information asymmetry, right? Which is to say you have kind of different actors in these networks, in these information networks, that have different views on information. So certain privileged actors have sort of privileged views on information. And I'm just saying this because I know this is very abstract. I have a background in HFT, actually, right? Like I worked
Really?
in traditional finance.
Yeah.
I worked at a quant hedge fund for a few years. That's where I started my career. This is not a new idea, right? This idea has been around forever, as long as there have been markets. Certainly as long as there have been electronic stock exchanges, probably further back than that. And it's a fundamental idea, and it's not going away anytime soon. It's basically arbitrage, right? So it's that you have, again, these privileged classes of actors who have information, access to information that other actors don't. And as with everything else in blockchain, we've invented a new name for it, MEV, which originally stood for minor extractable value, has been rebranded to maximum extractable value because it applies not just in proof of work, but proof of stake. But really, again, it's just arbitraging the fact that you have this privileged access to information. The classic example of this is front running. And again, this goes back to old school finance, right? So, it used to be the case, I think a lot of people did this, that, if you had a stockbroker back in the day, the client would phone them up and say, buy me 100 shares of IBM, don't spend more than, $100 on it or something, right? And it's called front running because these orders, you'd have kind of the brokers who would take the orders on one side of the trading floor, and they'd have to run those orders over to the other side where the trading happened on the stock exchange.
Are we going to get into the world of these trading companies who wanted to build they want to get the fastest internet speed, they want to build the closest
Sure.
possible
That's
exchange?
MEV too.
Is that
Yeah.
MEV too?
That's where we're going.
Yeah.
And was what Citadel were doing? Was that it?
Yeah. I mean, effectively, they're in TradFi MEV.
Yeah, and buying the data from...
We're going to get there in blockchains too. It's going to be all about latency and co-location and stuff like that.
Just to be let's be very explicit about this. This is actually something the fund I used to work for did, right? We would literally physically attempt to co-locate our infrastructure, our physical machines, as close to the various exchanges as possible, so that we could transact with them in less milliseconds than the competition, for exactly this reason, because speed is key. You want to be able to get those orders in faster.
Right. Okay, so how does this work in terms, or how is this abused in terms of...
Yeah, so let's fast forward to kind of crypto. Let me just get to that part of the story. So some smart people kind of figured out that this was happening around 2020. So it's not that the phenomenon is recent, but I think it's been articulated recently. So Phil Diane and some of these really smart folks, there was a paper called Flash Boys 2.0 that introduced this concept and talked about how there's different strategies, right? So I think largely this grew out of DeFi. The DeFi summer was 2020, and specifically things like decentralized exchanges. So historically and even today, the majority of MEV on Ethereum is happening in places like Uniswap. And the most common example of this is called a sandwich trade, right? So if I'm a miner, again, we talked about privileged actors. If I'm a miner or a validator and I can see the mempool, the contents of the mempool, and I see buy orders coming in for some particular, one leg of a particular pair, right? Which is how these decentralized exchanges work. I can insert my own buy order, right? Buy the thing first, and then let the other orders execute, right? So they will push the price up, and then I sell. That's called a sandwich order.
Okay,
that's a form of front running.
Yeah,
right.
And that seems entirely logical, especially if you could see massive orders coming in.
Right. And it's even worse if you're also an exchange, which we should talk about. But and
you can, I guess, I mean, not every, if you're a validator, you're not necessarily going to be the validator who closes the block, or is everything pulled?
you may be part of a pool or you may be a solo validator. Both things happen. But
you could probably also automate what you're looking for within the mempool.
okay, so so let's talk about how MEV works. I think this is how we arrive at an answer to your question. So the problem was identified. I just want to emphasize again, it's just so important to make this point when you talk about MEV. People tend to talk about MEV in terms of fairness, and they say, "Oh, there's a clear ethical line of behavior." There was some CoinDesk article, I think, arguing like people who are engaging in MEV are profiting from it or somehow evil or something.
I think it was described as the institutionalization of theft.
Yeah, and
I remember that.
I disagree with this on the strongest terms because MEV is fundamental. It's not going away, right? There will always be these information asymmetries, and in particular, like this is the whole way that Ethereum is constructed. That when we talk about trustlessness and economic incentives and things like, we want actors to kind of profit from doing behaviors that are constructive and assembling transactions and things like this. So MEV is not going away anytime soon.
But how does it warp the system? Like how does it warp incentives?
It could, in the extreme, do things like destabilize consensus. Okay, you could, in theory, have situations where miners or validators are incentivized to, for example, censor transactions that they don't like or something, or I don't know. I'm trying to think. A really extreme example here would be like if okay, I'll give you a very concrete example. And this would be in Bitcoin as well, right? Let's say that a block was just confirmed. Okay. But that block contained a transaction in it like that some powerful, wealthy actor didn't like for some reason. Maybe it was a fat finger mistake or something. And this has happened before, right? Then they could try to bribe the network by offering a transaction with a very, very large fee, like be in the order of millions or hundreds of millions of dollars or something, and try to get miners to effectively do a reorg and like ignore the block that was just created and reorg away from that towards this other block that includes this transaction that would only be valid as part of a reorg, right? That's been theorized. That could happen. That could lead to consensus instability is what I'm saying, to like a fork.
I have a simpler answer. I think the existence of MEV, it sets the validators at odds with the users of the blockchain. Yeah. The users, they just want to use the blockchain, do commerce, and not be, perturbed too much. They don't want to have rent extracted from them. Now there's the possibility to extract very meaningful amounts of rent from their ordinary transactions, and that profits the validators, right? So it is kind of like everyday users get punished for doing what they want to do, and it is to the economic gain of the validators. So it sets those two stakeholder groups against each other.
Yeah, I think that there's...
I think it's an inescapable feature of these kinds of blockchains, though. So it's also like just sort of a fact of life.
The naive response is, well, let's add fair transaction ordering. You've probably seen this, right? And there are a number of projects that have tried to do this. And there's some notion that, if we could just have fairness restored and have, first come, first serve, something like this. This doesn't work in practice because
you want to be able to bid for block space.
That's one reason.
Yeah, because it's an open auction for block space, right?
But even more fundamentally, these are complex distributed systems, and there is no simple way to order transactions.
There's no canonical
ordering. There's no canonical fair ordering, just like there's no canonical consensus mechanism.
Because the speed of light exists.
Exactly.
Hold on, let me jump around here. But if you went to...
In fact, the fairest ordering is exactly, you take the highest bid first. I mean, that is economically efficient, right? Or as close as you can get to it.
Could sharding partly solve this in that you don't know what's happening in every other shard?
I think
it makes it worse.
It makes it worse
because you have what's called cross-domain MEV. Yeah, we can get into that.
Okay. I'm glad we didn't rehearse that, but I'm glad we agree on that.
Right. Okay. Well, I mean, it feels very antithetical to what Bitcoin is solving, which is just to beat good money. But if you don't think of Ethereum as money, you just think of it as a system, a protocol for moving different types of value around, then I consider it slightly different. But if that could happen in Bitcoin, that would be something that would be very antithetical to being good money.
I think Bitcoin's going to have to grapple with it eventually.
In what are the scenarios where it happens?
In the case where Bitcoin gains rich statefulness, which is like a Vitalik word the Bitcoiners don't like. But basically, if Bitcoin has more stuff that looks like decentralized exchanges or interesting, more complex transaction types, there will be economic value to be gained by being strategic in terms of the ordering of those transactions. So MEV, in my view, is an inescapable feature of a situation where it's like a principal and an agent. The miner orders things, and they're controlling value owned by someone else. It will exist if Bitcoin gains complexity.
Okay.
You could say it's almost like a good problem to have, maybe, for Bitcoin.
Well,
because
right.
it means it's more useful to more
It
people.
shows that there's, it's becoming more of a marketplace for all kinds of different things. Maybe Bitcoin won't go that way, right? There's obviously the school of thought that Bitcoin should do one thing, which is manage the UTXO set, and that's it.
I kind of like that.
That's like the dominant philosophy. But maybe if like Lightning and Taro and other asset issuance takes off, maybe if you see more side chains, more of these smart contract platforms that are based on Bitcoin, which is happening, right? Maybe if, Taproot causes more complex smart contract types, things like that, then you will grapple this eventually.
Even just relatively simple things like introducing stablecoins, which might be nice. That would introduce MEV as well, because you need to be able to swap them, back and forth.
There is a form of MEV on Bitcoin. It's just called 51% attacks. I'm not saying those are a feature of Bitcoin. They don't happen really ever, but that basically is under the banner of MEV.
Okay.
Because MEV is like an advantage to be gained by reordering transactions, and 51% attack is reordering blocks. So it is MEV, basically.
But it's a more imminent issue with Ethereum.
I mean,
Yeah,
it's to
quantify things.
hundreds of millions of dollars.
Yeah,
But what is the concern? You're like if you're accepting it, but what is the concern? Again, what does it warp? How does it?
Let's get into this.
We haven't got to
the fun part.
we haven't got to the good part.
So I think it helps sometimes to put things in specific terms. So I think we're looking at, as of today, according to the main source of information, which is Flashbots, is about $680 million of MEV have been extracted from Ethereum since early 2020.
But that's an undercount.
That's a floor, right? So it's probably a lot more. That's one specific.
How is it calculated? Give me examples.
So there is a project. There's also a company called Flashbots, right? Which is one of the main teams of people kind of working on this, both building products around it, but also doing research on it in the Ethereum ecosystem. So broadly speaking, the approach Ethereum has taken is that MEV is unavoidable, as we both agreed. And as a result, the best thing we can do is drag it into the light and democratize access to it, make it so that any validator, anyone producing blocks, can at least benefit from it, and also try to decentralize it as much as possible. So you have kind of multiple search. So searcher is just the term that's usually used to refer to the people actually doing the arbitrage work and actually assembling these transactions and ordering them, and then have an open marketplace, right? So that they can bid and offer these bundles of transactions or these full blocks to the block producers. And so this gets into an area called proposer-builder separation, which is a proposal in Ethereum to address some of the censorship concerns. Risks. So, I mean, the most obvious one is that, what are the numbers? We were just looking at this. Something on the order of 30, 35, maybe as many as 40% of the blocks being produced in Ethereum today are censoring transactions, full stop. And that is because of infrastructure like Flashbots, which is compliant. It's OFAC compliant.
Oh, so, okay.
So what changed post-merge is it became institutionalized, this MEV concept. Flashbots is the main actor there. Most validators use them to sell the right to third parties to arrange transactions.
About 50%.
50%.
Who are they selling it to, and who is paying to have these transactions censored?
These searchers, right?
Right. So searchers are
call
paying.
Them that anymore.
Searchers are paying. Basically, they offer. Let's just call it. Sometimes they're called bundles of transactions. Let's just call them blocks, right? So they assemble a block with transactions in a particular order that they like, and actually people pay them as well. You can also pay them to get, for example, front-running protection, right? If I, as an individual trader, wants to make sure that I don't get sandwich attacked, I can pay the searcher to insert my transaction at the front of the block, something like this, okay? So it's a whole complex ecosystem. And then those searchers put these blocks onto a marketplace with a bribe or a bid attached to them. And so they're paying the proposers to take these blocks, and proposers are just ordinary people who are running these validators, or they could be the large actors.
I mean, because think about it. You're a validator. Let's say you're Lane running your validator over here. You don't have the time or the energy to like look at Uniswap and decide how to arrange transactions so you can extract maximal value.
That's a very complicated thing to do.
Where are they? What's the value they're extracting? What's the additional value they're extracting?
This is MEV. This is what we're talking about.
Yeah, no, but what is the actual like? How they increase value?
Things like this?
It comes from.
There's many other flavors.
The main thing would be giving end users worse execution on their transactions. Right. So they want to buy X amount of, they want to do a swap on Uniswap. Maybe instead of having 5 basis points of slippage, it's 30.
Right.
And
okay.
so the searchers and the validators capture that.
We have a term for this in traditional finance. It's called picking off the retail investors.
Yeah,
unsophisticated.
It's just pure rent extraction.
And was this what was essentially happening when Citadel were buying retail data?
I would say it's very similar. Yeah, very similar. And also the similarity is that it's only very sophisticated large firms that do it well.
By the way, if you've ever used an app like Robinhood, I mean, you know Robinhood's business model, right? This is Robinhood's business model.
They sell
They sell
front running.
Yeah. This is their. It's so institutionalized. It's like the water we all swim in.
And no one
traditional
complains
finance world.
about it.
Right?
Yeah.
Because they get to use Robinhood for free, right?
And so the problem is now there's basically one entity in the Ethereum ecosystem that's super sophisticated about MEV, which is Flashbots, and they are the big aggregator in the marketplace where everybody comes. The problem is they happen to be, I believe, a US company, and they've decided to basically comply with OFAC, in my opinion, over comply. And so if you're using Flashbots, for the most part, the blocks themselves are excluding OFAC transactions.
But that's not, you said that's 40% of transactions.
Currently, roughly that, yeah.
Why? What are these transactions that OFAC are requiring them to be censored?
Well, I mean, Tornado Cash is the most obvious one, but basically there's a hard-coded set of addresses. So there's first and second order, right? So the first order is the actual set of addresses that OFAC has specifically designated and added to their SDN list, right? And this includes Tornado, but it also includes addresses associated with SDN, these specifically designated people on the sanctions list. But it's more complicated than that because it's also people who've transacted with them. So there's the second order effect. And that's where players like TRM Labs come in, right? So there's folks on Chainalysis, right? Folks who come in and offer this as a service and let people, check an address and see if it's on this list or not.
I'm just amazed that many transactions would make it onto an OFAC list.
Not talking about transactions. We're talking about blocks.
Yeah.
It's not 40% of the transactions.
There's not really a lot of transactions that are actually interacting with like Tornado Cash.
For now.
I mean, it's been Tornado Cash usage has just fallen off a cliff, really. But these are blocks where you can tell that they are explicitly not engaging with the sanctions list.
So it's specific transactions within a block. So 40% of blocks feature some form of censorship within it.
Yeah, it's what's not there, not what's there, right? So the point is, right, they would be specifically producing compliant blocks that would not include any transactions that touch any of the sanctioned addresses. And I want to just quickly mention, this is actually, I don't know if you're aware of this, it's a really hard thing to do in Ethereum because of the way the EVM works.
Yeah.
In fact, censorship itself is a denial of service vector. This goes back to what happened after the DOS attack. The really short version is that you can very easily censor a transaction that directly touches or interacts with a sanctioned address. But there's all sorts of forms of kind of indirect interaction that are actually very expensive and complicated to detect, and they actually couldn't be censored in the first place effectively. So it's a very hard problem also.
But I will say that like the Ethereum community is very aware of this. So it's not like this is happening and they don't think it's a problem or something. Right. I mean, I would say opinions are split. But there are attempts to kind of remediate this.
But like Robinhood users are getting a trade here. They're getting the fact that, they're getting front run, but they're getting to make free trades. So there's a trade-off.
Well, they're not actually free. That's the point. They just don't understand that the cost is baked into the price they're paying. It's what it's like. Yeah. It's like if you show up at an airport and you want to do a currency exchange, and they're like commission-free trading, but of course there's a spread baked in that you can't see.
Yeah, no, I get that. But what I'm saying is there is a trade-off there. But within what you're saying here, within Ethereum blocks, that there is no trade-off. You are just at a disadvantage.
Well, the main problem we're identifying here is not the existence of MEV, which we think is inherent, but it's because MEV creates this centralization vector that is now used for censorship.
You're right.
What I'm saying is it's not like, because I'm not front running, I get free gas.
No, but you're right. There is a disadvantage to the validators. Actually, it's interesting. There's a disadvantage to the validators who censor because they're missing juicy fees from those transactions. And so there's actually an advantage to being censorship resistant here, which is quite interesting. At least that is working in our favor.
Well, theoretically, there's an economic advantage, but there might be a political disadvantage.
Right, exactly. There's no free lunch, no arbitrage.
And so how bad could this censorship get? Because it sounds to me like in some ways Ethereum is approaching being fully captured.
So this is the question. Ethereum's on a slippery slope. I think it's a very slippery slope. Other people don't think it's such a slippery slope. So, for example, like Vitalik has said, it's not a big deal if some subset, even some double-digit percentage of validators or pools or whatever are censoring, because as long as there's still a few who don't censor. I disagree with that in very strong terms.
How many pools are there?
Well, that's the problem. Is it's kind of a shrinking number. I mean,
it's centralized.
There's pools that are dominant, and then there's also like individual pools of capital that are dominant.
Binance, Kraken, and Coinbase. The three of them together is, I think, over 50%.
But they will all be compliant.
Most
well,
likely.
Coinbase says they won't.
But it's an interesting question about
Brian said on Twitter.
compliance. Yeah. So whether or not you have to, as a validator, exclude OFAC transactions is an open question.
Yeah,
I would say. So they're all kind of over complying. They're sort of trying to intuit what they think the government wants.
They're doing what companies do. They're listening to their lawyers, and their lawyers are super conservative. That's what you pay lawyers to do.
But at the same time, if the US government knocks on the door of Coinbase and says, or knocks on the door of Kraken, I mean, Kraken might leave the US, but what I'm saying, if they knock on the door and they tell them you have to do this, they're going to roll over.
So what Brian Armstrong said, right? This is one person. He is the CEO. He said that we would shut down our validators before we would comply.
That seems preposterous to me.
I don't know if they could, right? I think that
I
he'd
think
be
he would
responsible
be fired by
for
the board if
fiduciary
he did that.
duty. Exactly, a breach of fiduciary
His duty
duty
is to his shareholders,
Right.
and it's to maximize corporate value.
I agree
and that
100%.
means running a fat validation business.
So
because we're talking about a huge amount of income, and
that might be their bulk of their revenue.
And your fiduciary duty trumps your duty to
the Ethereum
network
community. Yeah.
your fuzzy sense of warm ethical benevolence towards it. I think that's
this fiduciary duty. Who enforces it, and how is it enforced? Because there'll be many times that people,
the shareholders.
So but that would require the shareholders to enforce it.
The board acts for the shareholders. They would probably fire him if they had a $10 billion a year.
What if the whole
business
board
line.
agreed it?
It becomes an interesting corporate governance question. Like, would the board prioritize, the values of the Ethereum community over maximizing shareholder value? My guess is it's the latter.
Obviously I'm not a lawyer, but this topic has come up on crypto Twitter a few times recently. It's interesting how few people in our community are even aware of what fiduciary duty means and why it matters. I was looking for precedent, and there's very little. There's vanishingly little of it, even in like Delaware corporate law.
Well, one example would be like Exxon. So Exxon recently had a shareholder revolt where the board installed these pro ESG activists. And so they deliberately made their business worse to be more environmentally conscious. So that would be an analogy, I would say, where you actually deliberately reduce your revenue in order to maximize a different value.
I agree. That's similar.
So that's like stakeholder capitalism.
I think the real question here, we could probably agree, is it appropriate for companies, right, that are registered, known entities, politically exposed entities, to have such a strong influence over these networks that we want and desire to be somehow outside of all these politics in the first place?
Right.
That's the real question.
No, of course we don't.
And so in this respect, you could say Ethereum has been captured or is rapidly moving towards being captured by
and are we even doing anything new if we have de facto
100%.
surrendered governance of these networks to large financial institutions?
And it's only going to get worse from
I was going to say, do we have any data yet that is highlighting that it is centralizing even more, since the merge?
Well, I mean, it was pretty decentralized pre-merge. It was a bunch of miners.
But post-merge, we have the pools. We have the large pools. Is there any evidence to show?
How has the composition changed since it's only been 3 weeks? I think it's too soon to tell.
So there's nothing yet to.
I mean,
I think what Nick said is very true. I think that over time, the stake in these exchanges specifically only tends to go up.
Well, here's one reason: is because there's regulatory barriers to entry to being an exchange. You need now, if you're going to start a Coinbase competitor, you would need at least $100 million in startup capital,
and strong economies of scale that are getting stronger.
Right, and the government is going to make it very hard to be a large regulated crypto exchange in any jurisdiction. The EU just passed all this complicated regulation. I'm sure it'll happen here. There's not going to be that many large crypto exchanges. It's in the government's interest to have a small number that they can control.
But you can independently be a validator yourself.
Yes.
Sure.
Unfortunately, there's not a lot of independent validators.
So I just wanted, this is actually interesting. So when people naively look at that famous pie chart, from Dune Analytics or whatever, the breakdown, and we should include a link in the show notes because it's really interesting for people to see it.
Did you find it, Dan?
Yeah. So if
Pull it up
you
behind Liz over here.
She's
looks
nicely
thrilled.
positioned when we.
Ethereum proof of stake validator breakdown probably would be sufficient, and if you include like doing analytics or something, you'll find it on crypto Twitter as
She's
well.
nicely positioned when we bring up a like hilarious article. She's just like join us in.
Hi,
She
Liz.
looks so happy. I don't think she's that happy.
Should we get
these
her
days.
don't think
opinion
she was-
on?
That was in the before times.
Yeah, that was before, that was before the political merge.
So when people glance at this pie chart, which hopefully Danny will kindly throw up on the screen in a sec, you see this very strong, what is it called? This long tail effect, right? Where you have these 3 or 4, colored squares here, right? Exactly. Okay, so this is perfect. Thank you. This is really, really good. So you'll see if you just add up the top, 3 or 4 or whatever. I mean, you can even see visually the top
Hold on.
2. You're already at like almost 50%.
Is unlabeled the name of a pool or something that's not labeled?
That would be a
That's
great
just-
troll
That's
if it
just
were.
other.
Yeah.
Right. But the main point I want to make here is that Lido Finance is decentralized. So this is actually not a single
That's
actor. I don't
true.
even know if Lido
That's
itself
true.
as an entity has any censorship control whatsoever. I think they may not. So actually
It's about
everything in this blue
yeah.
here, this is actually a bunch of home validators.
So Coinbase, Kraken, Binance is what?
That's
about
true.
30%, 32%.
But remember another thing, and yeah, so we have to be fair to Lido Finance because it is composed of many.
People misunderstand this, and there's been a lot of FUD around this.
But and so
is this like the most recent? Because I'm not sure.
That may not be.
I'm not sure this
May
is
not
totally
be.
up to date.
But the thing to think about is the trajectory that Ethereum's on.
Right.
Is it going to get easier to run a validator as an individual, or is it going to get harder? As we get into sharding, my anticipate and as
Let's go. First, no, this
it'll get
is
harder.
It just gets harder.
And slashing means I don't have a strong incentive to run a validator as a normal person because I might screw it up and get slashed.
right.
So I'm probably just going to do it with a large institution, like a Coinbase.
It'd be fun, by the way, to put the Bitcoin mining pool breakdown up here, and you could do a
Yeah, I mean,
quote unquote fair side by side comparison.
I think we should be fair because right now in Bitcoin, the blocks are being constructed by the pools. And so if Bitcoin wants to have the moral high ground, we need to remand the block construction back to the miners themselves. That's not currently the case.
Wasn't there a proposal by Matt Carlo to do that?
Yeah.
Is this more recent?
Yeah, I mean, you see how big that Lido slice is. I think again, people
But
kind of.
is Lido not?
Who is? I wonder who Daniel Wong is.
Wow, he's a Chad.
Should get Daniel on here.
Lido is accountable to the US in some ways,
Yeah.
but it is a constellation of different validators.
But does the pool itself as well, like Bitcoin, when we talked about, does the pool construct the block?
I think some pools, yes, some pools no. It depends.
We have
on the pool. There's
validated-
multiple pools up here. There's Rocket Pool as
But
well.
I'm saying, does Lido construct the block? And therefore,
my understanding is no. My understanding is
well,
it
yeah,
doesn't,
now
but
we have the proposer builder separation in ETH.
okay.
So the validators aren't even really doing it. But, they still have a ton of influence. In Bitcoin, to answer your question, Peter, there's a proposal to basically have the miners template the blocks. And the difference with Bitcoin is there isn't MEV right now. So it doesn't really matter which transactions you include. So it is something that anybody could still do. Until there's MEV, it'll be something that's relatively easy for anyone. So it would still be sort of more decentralized.
And is there a slight different issue in that? How would you front run Bitcoin? You'd front run based on massive buys and sells, but they tend to happen on the exchange anyway.
Well, yeah. So that's the thing is there just isn't a lot of MEV on Bitcoin
Yeah.
because there aren't big decentralized exchanges.
Yeah. But that the growth in its decentralized exchanges would raise that risk.
It
for
would
Bitcoin.
create
yeah.
MEV, yeah.
Yeah,
So
interesting.
like there's a school of thought that if you want Bitcoin to succeed, you want it to be more stateful. You want there to be more richness behind the transactions, not just moving UTXOs around, but maybe doing other stuff.
In fact, I think people would argue, like Bitcoin maximalists would say, we don't want this stuff running on Ethereum. We want it running on
want
Bitcoin.
it, yeah.
And I think we all agree that'd be great, but then you get MEV.
So
you
it-
can't have a free lunch, right?
It's
but-
something to be aware of.
If it happens on Lightning, does that change it?
Lightning would still be exposed to it because Lightning transactions are Bitcoin transactions,
I mean, less, I think, because Lightning transactions are not in the mempool. They're not like on layer one. Right?
There's more privacy.
But powerful actors would be running channels that are popular and they'd have
Yeah.
access to privileged. It would end up being the same thing. I think.
Okay.
As long as you have a public mempool and you have miners that have influence over the construction of the block, you're going to have MEV.
Is there no way to mask what a transaction is in the mempool, and it's only revealed once the block is built?
Great
So
question.
some of this is actually happening in Ethereum. There's kind of plans to do some
and
of
other
this stuff.
blockchains too. I mean, there's now private smart contract blockchains. Part of the idea is to solve MEV. I don't think it solves MEV
Why not?
because there's techniques you can use to try and ascertain what a transaction is, even if you can't see clearly what it is.
Yeah, you shared this fascinating symbolic MEV.
Yeah, there's a good
proposal
talk from Georgios Konstantinopoulos, great name, fellow Greek. And basically his point is you can probably still figure out what a transaction is doing, even if you can't directly see the transaction.
How though?
So this proposal takes ideas from software security, right? So when you're testing software, poking holes, this is kind of some of what I do in my day job. There's different techniques you can use. There's what's called white box, black box, gray box, right? So white box is like, I fully understand what's happening inside the box. And black box is, I abstract it completely. I have no idea what the code is. I can't see it, but I can still try sending it things and seeing how it responds, right? So you can still do this like black box testing. You can do something called fuzz testing, where you send millions or billions of different types of like random data into a thing, whether that thing's a smart contract or an application or an API or something, and try to break it in different ways. So these are techniques you can still use.
I'm glad that you read the slides because I wouldn't have been able to explain that.
Okay, right. Okay, so there is a heightened risk of censorship and OFAC compliant censored addresses. That's obviously. That's one scenario, but what about a scenario whereby, like, I think what I'm trying to get to is the slippery slope where there's things that are being censored by the government, for example, like what we have with truckers.
I think this is the really pernicious
Like
and really
control
dangerous
of
thing.
money. It's the control of money.
You get this overreaction, right? So what we saw in the wake of Tornado Cash is not simply companies, let's just use the word companies, kind of stepping in and explicitly censoring transactions that explicitly touched, the explicit addresses on the OFAC list. What you get instead is this simping behavior. I don't know what to call it. This rolling over behavior.
Effect. I would say chilling effect.
This chilling effect, where you see both companies going way above and beyond what OFAC has specifically restricted, right, in order to just be as compliant as possible. And we saw this in DeFi. We saw, again, these lists published by companies like TRM Labs and like front ends just banning access to anyone who even touched Tornado or touched something that touched Tornado. There was this dusting attack thing that happened, and like all these important influential people, their accounts got put on this blacklist as a result. That was brilliant, by the way. But another chilling effect, which I really want to touch upon, is it's chilling the development of privacy. I have a lot of friends, people I love and care deeply about, who are working in this space, and they're fucking terrified.
Because what happened with Tornado Cash?
Because they put one of the developers in prison in the Netherlands. Can we talk about this? Like, what the hell is going on?
Yeah.
We can talk about
And
that.
This is insane.
They sold his stuff.
And won't let his wife talk to him?
Yeah.
Like, what is actually going on? This is terrifying.
Do we know the status of his legal case?
Unclear. But I mean, it's remarkable that the Netherlands, an ostensibly free country, is doing this.
It blows my mind. It blows my mind. Also that more people aren't talking about this.
Well, so that was one of the things. I think it might have been Miles who came out with a good thread. He said, like, Bitcoiners should really care
Sit up
about
and pay
it.
attention
And
to
I
this,
think,
right?
I think a lot of them do. I think the ones who don't haven't really thought through the hypocrisy of their own positioning on it. I just don't think they've thought it through.
I mean, Bitcoiners should be impressed that Ethereans are now stepping up and being more cypherpunky, because for a while they weren't. Now the Ethereans are actually in the firing line.
Yeah.
So Bitcoiners thought they were the hardcore ones. There's some Ethereans that are now, really sticking to their guns.
Some are, and some have stopped working on. Some have stopped working on privacy stuff entirely. I can tell you this from conversations I've had with friends in the past few weeks. It's that people are really scared, even U.S. citizens.
Yeah, I mean, look, there was a certain number of lawsuits over the last couple of years that have had a chilling effect on Bitcoin developers. We saw a number of people step back. We saw Peter Wille step back. Jonas Schnelly step back. We saw a number of people. It happens, and if you've got a fear for, there's being fearful of having a lawsuit, but going to jail is an entirely different proposition.
Yeah, like Virgil Griffith. Like what happened to him? Like all he did was give a talk in North Korea. I'm not an apologist for that.
He made a transaction, apparently.
Oh, did he?
I think
Okay.
my limited understanding, that's actually where they got him.
It wasn't wise.
There's
He transacted with North Korea.
There's building privacy technology, and then there's going to North Korea and giving a presentation.
It
that
wasn't
explains,
smart what he did.
It wasn't.
Well,
But
he
to be
also
honest,
advertised the fact that he was going. He invited me on the trip, by the way, and a bunch of other people.
Glad he didn't go.
Was he paid?
I don't think so.
Did he deserve like X many years in federal prison
No,
for
of
that?
course not.
I
But
don't
like
think
at the
so.
same time, I don't think Ross Ulbricht deserved
Right.
his entire time in
2 life
prison.
sentences,
2
right?
life sentences for
Yeah.
40 years.
Yeah.
I don't think he should have been tried like El Chapo.
But
But at the same time, when he did it, he knew the risk he was taking, right? He knew if he got caught, he's going to be arrested and he's going to be charged with something. And what I'm saying, so just to finish, I think Virgil must have known he was taking some risk. But this guy, what's his name?
Roman
Yeah.
something.
Like he's building privacy technology.
He did a thing which, at least, again, I can't speak to Dutch law or whatever. He did a thing which is constitutionally protected here under free speech. I mean, and we fought this war in the 90s. We fought this in the crypto wars.
They don't have the First Amendment over there in Europe.
Good to be American.
Yeah, seriously.
I can personally vouch for that. But has he been arrested under pressure from US government? Does it come from there, or is it just the Dutch government?
This is a good question.
The
I think we don't know.
the whole sanctions edifice is a U.S. political tool, right? I mean, and like SWIFT is nominally a Belgian entity, but they enforce U.S. policy. The U.S. has its tendrils all over the place.
Yeah.
This is part of the dominant like institutional regime they operate.
Apple has gradually provided more and more privacy tools for your phone or your laptop. They've made privacy a competitive feature within the operating system.
I hate when people say that Apple is good at privacy.
No, I didn't say
it's
it's good. Did I say it was good? I said
they've offered
made
tools, but they've also undermined privacy in
Of
other
course,
ways.
what I'm saying is they've offered tools. They've worked on privacy.
Sure.
How is that different from somebody working on a different type of financial privacy?
I mean, this is the U.S.'s one last remaining weapon of war is sanctions. It's all they have. They don't want to go to war with tanks. So it's their last tool. It's becoming blunt. It's becoming extremely blunt with overuse. Everyone hates it, the fact they use sanctions so aggressively. But they don't want to give that up. So they will fight to the last breath.
Look at I think it was sanctions, right? Freezing of Russia's sovereign funds. I mean, I feel like you spoke about this, how unprecedented that was and how you could only get to do that once or something, right?
Well, they froze Afghanistan's, sovereign debt too. Venezuelan. But yeah, like
We've
a
got that.
G20 nation.
We've got the Venezuelan gold
We have it?
in the UK. Yeah.
Yeah. So, I mean, but yeah, Russia, a G20 nation, I thought the sanctions wouldn't work. I don't think they've worked. But, the U.S., it's all they have now. They don't actually want to send
So is the
infantry
difference here?
anywhere.
It's not that he was providing a privacy tool. He provided a privacy tool that was used in contravention of OFAC requirements.
We know that North Korea was using Tornado Cash.
And it made up some substantial portion. We don't know the exact number, but some double-digit percentage of all the funds flowing through it. I've heard 40%, something. It's a large number.
of the transactions were from North Korea.
A lot of the pool was illicit, whether North Korea or other hacks.
And
that's probably why it happened and why it happened relatively quickly and why it was Tornado Cash and not other mixers.
right. Okay.
And let me be very clear. I don't think any of us are arguing that we want to facilitate, North Korea or any of these other kind of state actors, nefarious state actors to do these things. But we have to balance this against the fact that privacy is fundamental and it's a human right. And
But could Tornado Cash have blocked those North Korean transactions, or is there no way they could have known?
they couldn't have blocked them
Censored them.
because Tornado Cash, just to be clear, it's uncensorable, right? The actual smart contract is still running. You can still interact with it. You can do various things on the front end, and they had some feature baked in or something where you could generate a receipt to kind of prove that the funds that flowed in were not illicit or something.
You could prove the licitness
correct.
of your...
And people kind of lied over this in a lot of the commentary. So there actually were efforts made.
Tornado Cash was deployed and then the admin key was burned.
Right.
Well, there are many pools actually. But so the admins had no residual control over the contract.
Okay. So even if he'd exited the project, he still could have been arrested, or because he was still benefited from it?
So look, I think we have to wait and see. We have no choice. I think that there's things going on here that we're not aware of, and I hope it all comes to light eventually. I've been taking a wait and see approach.
I mean, there was a token, so that might be the angle they used.
Right, is that he was actually personally profiting from it.
Financially benefiting from the usage.
Although I heard that the fees hadn't been turned on or something. I don't know. It's very complicated.
Right. Are we at the point where we should just now compare a lot of this back to Bitcoin? Or is there anything else you still wanted to add?
I think, my two key things were censorship and MEV. I think we covered
so
that pretty well.
you said, we've covered that. Look, it's possible and it will become...
one point.
Yeah.
So we didn't actually ask the question, like, what can be done about it, right? We kind of established that it exists. We kind of established that this censorship is happening. So it might be worth just taking just a minute or two to just talk about the Ethereum approach, and then maybe we'll transition back to Bitcoin, right? So in defense of flashbots, whom we spoke about earlier, they seem to recognize, and they have been, some folks have been very vocal on Twitter and some other places, the effect that this is having, and the fact that the number of blocks being produced that are censoring is going up, and that they're responsible for this in some fashion. And so their approach is, educate, democratize, open source, and they're doing that, which is exciting, right? So I was actually playing with this. Just sometimes it's good to have hands-on experience. Like, what does it mean to spin up their software called MEV Boost and connect your validator to it? And there, what you do is you connect to one or more relays. Okay, and the relay is the way in which your validator kind of gets the block. So this is how the builder or the searcher hands the block to the proposer, which is the validator, and submits it to the network, right? And you get these blocks in exchanges for fees, like we talked about. So the software, this MEV Boost thing that you connect to your validator, there's no default relay, right? So there is a Flashbots relay, and it is censoring, and they've been vocal about that. They haven't sort of tried to hide that fact, but there are others. So there's Blocks Route, right? It's another, I don't know if it's a company or organization or something, and they offer, I think, 3 options, right? So one of which is a compliant router, and a relay rather, and one which is not, one which is called Max Profit, which is kind of cool. And so that includes, like we spoke about earlier, like it would be more profitable to include all the transactions. And that's a good thing, right? And the idea is that if we encourage this ecosystem, if we make this research public, if we open source the software, then other actors can step up, other actors who are not exposed, or maybe they're pseudonymous, or maybe they're in other regimes or something, other jurisdictions. So that's kind of the best possible outcome for Ethereum, that more decentralization happens, that we move more towards proposer-builder separation, which ultimately will land in the Ethereum protocol itself, which also may address some of these issues that we're seeing right now. That is actually on the roadmap as well. That's a snapshot of where we're going on the Ethereum side.
The way I'd compare it back to Bitcoin is like, okay, well, how does this matter for Bitcoin?
Right.
Well, can I just say an observation? One of the observations I have about Ethereum, my limited understanding of it and not being technical, is it kind of reminds me of the British economy right now. You pull one lever and you have to fix something elsewhere. Okay, so you have to create a new sticky plaster for what that's created. And once that's created, there'll be a new sticky plaster. We have it in the British economy right now because, we have tax cuts and then the pound crashes. So they raise the interest rates, which means houses become unaffordable, which means we have a housing crash. We're seeing this economic tug of war.
We talked about previously the difference in values, right? So Bitcoiners value security at all costs, and Ethereum folks value innovation, and they don't mind the complexity. And so I agree with you. I think that there's complexity on top of complexity, like we talked about, and to address that complexity, you need to add more complexity. Yeah. So I agree. That's what's happening here. And if you look at the actual proposals for things like proposer-builder separation or censorship resistance, right? We were talking about this idea of CR lists and this fallback mechanism, so we can make sure that there's always a way. They're wicked complicated. They're very complicated.
Yeah, and how many holes does that leave? How many new attacks? How much does that increase the attack surface?
Every time you add complexity, you increase the attack surface. No question.
I think it's incontrovertible that the merge has increased complexity, which in turn has made it easier to censor Ethereum. I think that's undeniable. Maybe they can address it. They are aware of it. But Ethereum has become more censored since the merge. Okay,
so bringing it back to Bitcoin, like we've talked about MEV, it's not a huge issue right now, but it's something that may depends how it develops. But yeah, but with regards to censorship, that's the area I'm super interested in because I know Marathon attempted to create.
Others will. I can assure you of that. Bitcoin's not 100% pure upon its pedestal because we're still relying on pools to construct the blocks. Can we get away from that? Maybe. There's attempts to create Stratum v2, other ideas which would give miners more control over the block construction. And so then your pie chart doesn't look like 3 big pools. It looks like a zillion miners. The other thing to mention would be...
The pool is purely there to share the revenue.
What's that?
The pool would purely be there to share the revenue.
Right. It'd be there to minimize the variance of your mining. So the pool would have much less sort of political power.
Yeah.
It is worth saying that pools can lose hash rate in real time, which is kind of not the case for validation in proof of stake. For instance, recently, what was the pool that was insolvent? Was it Poolin? Poolin,
Yes.
they were insolvent. They lost tons of hash rate almost instantly. We've seen this happen before. So the pools don't have that much power in real life. If they
How does a
started
pool end up
misbehaving,
insolvent?
I don't know.
It's not a very profitable business, weren't you?
It is.
saying this?
That is another thing about pools, which is
Which is why there aren't more of them, and
It-
they're not larger. Than
Yeah,
they
it's
are.
good for our purposes
Yeah.
actually, in terms of like avoiding the large points of centralization. Running a pool, you basically lose money doing it.
Which, by the way, like maybe you could explain this. It's interesting because it strikes me that it's a great example of economies of scale. You have a piece of software, you have a marketing budget, you get people to sign up. If every additional miner who joins, aren't you just taking 1% off the top or whatever?
It's
Like, why
just
is that
super
not?
competitive though, right? So
right, it's a race
that
to the bottom.
compress the margin.
There's
It's
no
race to
real
the bottom.
differentiation.
Yeah,
Yeah,
and some miners often misbehave and like screw over the pools
Right.
in a certain way, depending on how they pay out.
The incentives are kind of
rewards.
misaligned, yeah.
It gets so complex actually. In terms
As
of
by the way,
payout
as a
models.
miner who's part of a pool, even someone who kind of understands how this stuff works, it's crazy complicated.
It's
How
so
do you
complicated.
audit that the pool is doing what they're supposed to do? It's almost impossible.
Yeah, that's actually that's kind of an unsolved problem. And there's like paper share and like it's anyway. We don't have to get into that.
Maybe we need better pools. That should be an active
I
area
agree,
of
but
R&D.
there will be U.S. entities that create OFAC compliant pools. The question is, what do we do then? Maybe
Why
we
though?
have-
Why will they? Just because they want to
for the same reason that any other entity in Ethereum is complying with OFAC.
because they don't want to take risk over.
yeah, they don't
Because they don't want to go to jail.
Yeah.
we
because
talked about.
the C-suite is personally liable, and you have strict liability for OFAC.
So why aren't they already?
Well, good question. They might be, actually. There's kind of ways to measure whether pools are selectively excluding transactions. We don't think they are censoring right now. It's hard to measure directly.
Right, it's hard to find a thing that doesn't exist, right? Because by definition, like we talked about earlier, like the act of censoring is not including a thing. It's easy to point at a thing
Yeah.
and say you did that. It's very hard to point at a thing and say you didn't do something you were supposed to do.
You
know what
would
I mean?
want proof.
There's an asymmetry there.
It's hard to find proof that they're deliberately excluding OFAC transactions.
Right.
It looks like they are including them right now at sort of the normal rate. Not that there's a ton on Bitcoin.
I think something we didn't touch upon, which could also be interesting, is that paradigm opinion piece about how this layer one infrastructure work should be considered neutral, should be no different than operating a telephone network or acting as an ISP, right? In other words, like ISPs are not today liable for the packets they transmit if one of their users is sending child pornography or something. That's absurd, right?
They're
Even-
common carriers.
They're common carriers. You could probably explain better what that means, but they're not expected to do some form of deep packet inspection or something. So why can't it be the same, right? If you're simply assembling transactions into blocks and publishing them, you're not facilitating in some meaningful way, transactions with these sanctioned entities.
Yeah.
Because Lane, ISPs aren't a existential threat to the revenue stream of the government.
I mean, governments have an incentive to control the internet, right?
Yeah.
Like
And
certain
it's getting
governments
worse.
do, right? And the U.S. government, maybe they want to change this model, but
Yeah, but with Bitcoin, we route around the government.
well, there's U.S. entities that manage key points of the infrastructure, and they want to play nice. So I do think Bitcoin will face the same issue as Ethereum eventually. It probably won't be as bad because MEV isn't a thing for now. And so we won't have these like super sophisticated, highly centralized entities that are like doing this block construction work. But we will be confronted with this.
Well, but OFAC compliance is kind of like one of those things that people may reluctantly accept. It's that next leap that you fear, say, with Ethereum, what Coinbase or Kraken might censor when somebody knocks on the door or turns the screw on
That's
them.
exactly it. It's a
Well,
slippery
yeah.
slope.
Yes,
OFAC
slippery
is very
slope.
minor in the
But-
grand
but-
scheme.
Right.
But when you look at miners in Bitcoin, they may become OFAC compliant. What is the different scenario for Bitcoin when the slippery slope hits, when it's something beyond OFAC compliance? Can those miners can say no or can't say no, or can they be?
There was an announcement,
Can they be like extract? Can they be out? Can it be extracted from the system? Is there a different structure that means there's less risk, or is it a case of, in reality, how much hash rate's in the US? If it's 10%, does that mean you might miss one block, you'll be in the one after? That's not
10% is not so bad, but that's why I keep saying it's a slippery slope, because where would you draw the line? What amount is safe, right? This is kind of, when people
What
say
I'm
it's
saying
okay,
is-
I turn it around and say, where would you draw the line? If 10% is okay, what
I
about
mean,
20%?
we
What about
have
30%?
like 35 to 40% in the US.
Okay. So you could, worst case, you're going to wait an extra couple of blocks.
So I just wanted to mention there, which is not so terrible, right?
Yeah.
But again, it could get worse, and I think it might get worse. There was an announcement a day or two ago that EU sanctions were stepped up on everyday Russian citizens.
Correct.
So not just in terms of custodial exchanges, but sort of
Wallets.
non-custodial wallets as well, or something.
No, it's this, isn't it? Custodial wallets.
Yeah, I think it's
Custodial.
service providers providing wallets to Russians.
But not just individually sanctioned individuals or entities. It's like all Russian residents and citizens. And I'm just throwing this out there because what is the worst case scenario? The worst case scenario is Bitcoin tries to kick all Russians off the network, which sounds absurd today, but it might not sound absurd, a few years from now if these trends continue.
Yeah, so the question is, how do we react if the government goes to pools or to miners and asks them to not transact with a certain group? I would hope that by that point, the miners would be more empowered relative to pools, so the pools wouldn't be such an obvious target. We would need something like Stratum v2.
What's the holdup with Stratum v2?
Just, it exists in sort of the idea world, and it doesn't exist in code, basically.
We need to make a show on that.
You do.
Yeah,
You should
do.
talk to Steve Lee at Spiral.
Yeah, let's do that. We'll message Steve afterwards.
There's a few groups working on it. So I'd say that's absolutely critical. Then also, what's the physical reality of where the miners are? They're distributed all globally, and they're not just in one place in the US. And we have states' rights in America. So America's not just this one big homogenous thing. So I'm actually kind of okay with the fact that there's a lot of miners in the US because they're on all these different states, and they're in some states that probably if the federal government came in and said we're like commandeering your miners, the states would be like, screw you. Texas.
Yeah, good luck.
Come on.
Come at me, bro.
Ted Cruz won't be having that.
Bitcoin is a states' rights issue, okay? So maybe it'll be the cause of the next civil war, right? But yeah, so like if all Bitcoin mining was in China still, yes, China is effectively one sort of like legal place. America is 50 different, jurisdictions. So that's kind of why I'm less worried about it. But we still have to be mindful of this stuff.
I mean, 51, we're really subservient of you over in the UK.
Oh, with the UK
You
being
could
a
add
state?
Canada to the mix too,
Yeah,
probably.
52, yeah. As long as Trudeau's there. Yeah. Okay, right. In terms of, before we start to kind of wrap up, is there anything I've not asked you or anything we've not covered here that we should have? Because really, where I want to get to is what has this kind of taught us about the future direction of Bitcoin, what people should be focusing on with Bitcoin, both in terms of the development of Bitcoin and the growth of Bitcoin as a code base, but also in terms of like how the community should be thinking about like how the community should be thinking about what it does to protect people working in Bitcoin, and what has it taught us?
Yeah, I would say there's not too much to worry about from a censorship perspective today.
In Bitcoin.
However, if Bitcoin becomes a richer environment with more on-chain transactions that are more complex than the ones we have today, I do think that introduces a significant centralization vector in the form of MEV, which is a very specialized activity. So the more you insert layers into the stack, which are super specialized, which a small number of entities are doing, then you are more beholden to the government because they only have to interface with a small number of entities. The other thing to be worried about would be if exchanges start buying Bitcoin miners. I think this will happen because they may want to give their clients priority access to the blockchain, right? So they'll recognize, hey, like maybe it'll be a value-added service for us to manage our client experience, their interaction with the blockchain. Exchanges now run validators, so they're basically kind of doing this for their clients already on the proof-of-stake chains. Why wouldn't they do it on proof-of-work? I think this cycle you'll see exchanges buying big miners so they can guarantee access.
They're on sale right now.
So exactly, they're going bankrupt. So that would be something to be nervous about, actually. It makes sense from a business perspective for an exchange, but at that point, you do have the convergence of the large amounts of financial capital and the validation, which is sort of the dangerous spot. So that's something which I don't see people talking about because it's not happening yet, which I actually would be nervous about if it does happen.
Yeah, I think it's a natural trend. As Nic was saying, if I am an exchange, I can offer cheaper fees, fee discounts, free transactions, faster inclusion. I can offer front-running protection,
Like
things like this. Like these have already happened,
inclusion.
by the way.
Yeah,
Exactly.
yeah.
Which I can't do if I don't have that infrastructure. And so that is another inherent centralization vector. I think we should take these centralization vectors very seriously.
Because it's very obvious there's only going to be a handful of global exchanges in the future. They already all have staking businesses. What if they then also move into mining once they realize Bitcoin's not going away? The big exchanges basically like sort of don't care about Bitcoin. They think it might, just be an anachronism. If they realize it's sticking around, they start buying miners because they want the same thing they have in proof of stake world, which is priority access to the blockchain. I'd be nervous about that.
And we should be encouraging miners to be considering distributing their operations a little bit more globally.
I think it happens naturally because of where energy is, because the ASIC supply chain is less controlled now, but really because cheap energy is available sparsely throughout the globe.
Right.
So that is sort of a very helpful state of affairs. It's kind of the same with gold. The number one country for gold mining is China, I think, with 11%. Gold is very well distributed in the Earth's crust. So it happens all over the place. There's no one place where all the gold is. Think of Bitcoin and energy the same way. There's lots of little hotspots of cheap energy globally, whether it's flared gas here, a hydro mine there, nuclear plant that's underutilized there. So that's one of the things that gives me great cause for optimism. The literal physical infrastructure of Bitcoin mining is getting more distributed sort of by the day.
This incidentally is not true in proof of stake, but we already covered that.
Very useful. I'll be interested in the YouTube comments. There are probably lots of little tiny clips that they've put together. They've got nothing to do with what we said.
Taken totally out of context.
People are going to complain that you did an Ethereum episode.
Well, I've done... How many have we done in the past? 3 or 4? Yeah, 3 or 4. Well, I mean, we've done 3 or 4 with Lane. No, we've done 2 with Lane. We've done 2 with Vitalik.
Have you really?
Yeah. We did one with Vitalik and Samson Mao, and then I did another one with Paddy, Vitalik, and Andrew Polstra.
I remember that one. That
it just didn't work out how I wanted it to. I actually agreed with Vitalik to do a third one, but only on Bitcoin. Just me and him talking about Bitcoin.
That'd be fun.
Yeah, but...
I think he's going to evolve his views on Bitcoin, actually. I think he'll come to see it as a very useful kind of bulwark.
Yeah. I'd love to have that conversation with him, so hopefully one day, but... he closed down his email address, so I can't get hold of him. But yeah, no, we will... Yeah, it is called What Bitcoin Did, but in making a show about Bitcoin, you sometimes have to understand other things where they've... what lessons have been learned from other projects.
There's a lot of lessons to be learned here. I mean, you have to look at the context, and I said this a couple of times, but just to reemphasize it, the transition on Ethereum's part to proof of stake just further... It makes them move even further apart. Ethereum has its roots in Bitcoin in many ways, right? Yeah. And it's now maturing and kind of it's like, the child, it's like going off in its own way and growing into a totally different person than its parent. And I think this is actually really good for Bitcoin because it just offers this really strong counterpoint.
Yeah, I mean, it's just interesting to understand and to learn about. We made kind of a half Monero show. We made a show about privacy, understanding that, this is still fundamentally a Bitcoin show. And that's what we cover. But this is useful for me to see and understand. I'm sure there'll be people out there complain, the same people who complain about every episode I make.
If they're not complaining, you're doing something
wrong. The bigger pool of knowledge you tap into, the more educated you become. And also, it's just good to see my friends. So,
can I get a final word in?
Yeah, of course. As long as you're not shitting some shitcoin. What are we going to call this show? A Tale of 2 Shitcoiners.
That's pretty good, actually.
I can't believe I'm a shitcoiner now because I just did
what
one
have
thing
you
wrong.
become?
If you care about privacy and censorship, which you should really sit up and pay attention to what's going on here because this is a big fucking deal. That's all I wanted to say, right? You should Ethereum's killer feature is composability. We talked about that. I think we'd probably agree Bitcoin's killer feature is things like censorship resistance. And it's kind of okay today, as Nic said, but the warning bells are sounding and we're kind of seeing this stuff happening in Ethereum and it is a slippery slope. So sit up and pay attention and figure out how you can contribute to making the network more decentralized, period.
Completely agree. Any closing thoughts, Nic?
No, fully agreed. I think probably the number one thing that regular Bitcoiners can do would be to advocate for a Stratum v2.
Yeah.
Or variants of that idea. Basically, decentralizing block templating in Bitcoin. That's the number one thing.
Yeah, we will get in touch with Steve Lee. We're up that way soon, so hopefully we can speak to him about that. Like I said, I know Max Corallo talked about it before. Was it his proposal or was that a different proposal? That was hash something. He had a proposal for something, but yeah. Anyway, we will cover that. But I appreciate you both coming in. Third interview of the day. I'm a bit tired. We're gonna have to edit that bit out where I couldn't even construct a block. And, yeah. All right, guys. Good to see you, man.
Likewise. Thanks for having us.
Thank you.